Good afternoon. This is Ken Long with the review of the weekend trading report for October 27th, 2017. The market remains in bullish, quiet conditions. On an annual basis, with NDX 260, we are overbought at a score of 100 out of 100. So it's an annual high. On a 10-day basis, using NDX 10, we are also deeply overbought at 99 out of 100. In the market mosaic, price with respect to the 200-day moving average is green bullish at 6.67% above the 200-day. Slope of the 50 is improved to green bullish at 0.41. The ADX is strongly trending upwards at 33.9. The risk index is the 30-period moving average of the VIX divided by the 10-period. 1.0 is the threshold between risk on and risk off. That reading is currently at 0.995. So we just nudged into risk off. Take that score, compare it to the last 5,000 trading days. We find the standard and the average, standard deviation and the average, compute the risk z-score. That is at minus 0.17. You can see here a 90-day time series of that indicator that has recently gone from minus 0.5 to plus 0.7 to minus 0.2 to plus 1.5. And then has been decaying slowly over the last 15 days and now just tipped into the negative. That's a sign of potential volatility shocks to the downside. Despite the fact we've had a nice upward gain, this tells me that the move that started down here and now has rolled over is getting long in the tooth, and so I have curtailed a lot of my new swing trade positions, and I'm ensuring that my capital preservation and profit target stops are in, and I'm emphasizing more of the shorter term trades which would benefit from a sudden volatility spike. Blended monthly rebalancing, next reevaluation is due on or about 1 November. These are the current holdings for this week, or for this month, and then for this week based on the performance of the last 30 days as of the close of business on Friday. Theoretical exposure in ETF2 is still 1.0. These are the blended monthly rebalancing portfolios for the 13 and the 32 ETF. You see the negative numbers here in treasuries and real estate and Australia. Strength in the Dow on the basis of tax cut news, I presume. Brazil, China, and the BRICS gave back a little bit this week as the U.S. financials and Dow 30 have moved to the front. I would continue to play for opportunities of that momentum going forward in the U.S. On the news of tax cuts for short-term momentum. The sector spiders, this is a look at a more granular level of sector performance, and you can see right now aerospace, innovative technology and biotech really dominating. There was a nice bump here in healthcare services this week. That could be the beginning of a turnaround, and so XHS ought to be on your short list for resumption of momentum, or continuation of momentum, I should say. This is the ETF Max, same logic, now looking at a broad set of ETF sectors around the world. ETF market health check here. This is the S&P. I want you to notice this work here that we're doing with the MACD, and this form of it is the PPO 10, 30, and 5. When you have these crossovers above the zero line, that's a favorable pocket opportunity. You notice that one here. You notice that one here. This was a natural profit preservation crossover back above the it's above the zero line but crossing back over, so that suggests that run is over, and then because it doesn't fail further, you get a resumption of the crossover to the upside, and that gets you back in here, allows you to take advantage of this opportunity. Now that gap closed during this period of quietude, and then there was this 1 day of short pullback. This was a great intraday trade. It was a big gap down and then a rocket sled of 5% intraday in the VIX. And then the follow through on Friday is causing the histogram to open again to the next. So I'm not surprised if we see this as leg 1 and another, this is leg 2, excuse me, and then a third leg up to about 262. would be the indication. The slope of the 30 right now, you can see right here, is at a point about 0.32, and so this is not exceptionally strong yet. Although it's getting stronger, the slope of this 30 period, it's not enormous yet. It's not above SD plus 1. It has to get above 0.40 to do that. So there still is room for another leg up inside the U.S., and that's the way I'm playing it. Quick look at the ETF2 lens. All the global indices are up, so that's why we're at 100% invested in the allocation strategy. The globals at 73 are still better than the U.S. at 70, so it's globals over the U.S. Inside the U.S., it's technology, then large caps, then small caps, then mid caps. You see weakness in the energy sector, spider, staples and discretionary, but strength in technology and healthcare. World market model. U.S. is a mixed bag. Europe is all above average. Selected elements of Asia are above average and mostly above average. Emerging markets still dominating, and then the European countries doing really well. The other asset classes suffering at the hands of equities, and so that's why I think the broad equities are still the place to be. The things that I look here for are green under the strength and white under the consistency. That's the emerging strength. So if it's white in consistency, it's above average over the last 10 weeks, and then green means it's exceptionally above average. And so the new strength is in biotech, China, emerging markets. These that are in white and then green are ones that may be running out of some energy. So you're seeing potentially a rotation away from European financials and more towards Asian and China and biotech. ETF liquidity, these are the ones sorted by average daily dollar volume of the last 30 days. And then green are the ones that are both volatile and liquid. The ones that are red and yellow are much less volatile and therefore harder to trade. Shifting to the daily, we got a couple channelings that fire, only a few in the mechanical setups here: Procter and Gamble, Chevron Energy, and then a handful that test out well on the auto framer. You can see the performance numbers here. We got some frog quality numbers beginning to come online. Procter and Gamble really suffered, and so this is in a relatively unique position compared to the other Dow tacticals, the other Dow components, which have all been really doing well. So Procter and Gamble is really the oddball out and should be a potential rebound candidate. In the ETFs, again, only a few test out well on the auto framer. You can see real strength here in industrials as they are as they've hit new highs on 10-day, 1 month, 3 month, 6 month, 12 months. So that's a good sign for continued strength in the U.S. economy. XIV continues to be the gift that keeps on giving, up 200% this 12-month rolling. Pinch and stretch report. Column 1, these are the ones that are the most stretched above their Bollinger Band mean, above the rivers. So IBM, Walmart, Travelers, exceptional stretches. The ones that are stretched the most to the downside, Procter & Gamble and Mexico, exceptionally stretched. The expanded pinch boxes are the ones that have wide rivers and therefore have had 30 days of consistent large directional moves. So Walmart, Johnson & Johnson, and Travelers. The most compressed pinch boxes are the ones that are poised for a sharp breakout in either direction, so the very narrow river. This subset down here, the daily super pinches, are the ones in which there is both a very compressed river and all four of their regression lines, the 10, 30, 90, and 270, have been compressed to a very tight degree. So these are ones in which everybody agrees what fair value is and the river is narrow, and that sets up a super pinch trade. Some members of the auto framer that test out very well on a reward to risk ratio on a test of the 10-day high. So all of these are well positioned for mechanical swing trading. Then the regression line fractal framework. In the green on the top shelf are the symbols that are the most ATR below their own RL270, and so these are ones that I consider to be deeply discounted value plays, and I frame the trade accordingly. And then the bottom stack, the bottom shelf in the red, are the ones that are the most overheated. And this is how many ATRs above their long-term fair value they currently are. So you see a lot of the technology and energy in those two, and not surprising since those two sectors are dominating. And that's how you read that report. So that's everything I want to cover for this week. Let's keep your risk measured and your powder dry.